Never waste a dollar to save 28 cents in tax, but New Zealand farmers get serious cash back on equipment purchases. Here is how to do it right. I'm John Dasley from CMK Accountants, and if you're a New Zealand farmer planning equipment or infrastructure upgrades, this video could save you thousands or help you avoid a costly mistake. Today we're going to break down the new 20% investment boost that started in May 2025, how it works, what qualifies on your farm, and critical mistakes that could cost you 72 cents in every dollar that you spend. Please stick around, we've got some real examples and practical advice that could transform your investment strategy. It all started on the 22nd of May. The government started to offer eligible businesses an immediate 20% tax deduction on new or new to New Zealand assets. This isn't replacing your normal depreciation, it's on top of it. And here's an easy example. You buy a $100,000 tractor. You will immediately claim a $20,000 as a deduction and then depreciate the remaining $80,000 as normal. That upfront deduction means cash back in your pocket this tax year. The New Zealand government expects this to boost GDP by about 1% and wages by about 1.5% over 20 years. For farmers, it's recognition that agriculture has a vital role in New Zealand's economy and a genuine opportunity to modernise operations with better cash flow support. Say you need a new irrigation system costing 80 grand. The traditional approach would be pay 80,000 up front and depreciate over several years. The tax relief comes gradually. With the investment boost, pay $80,000 up front and then immediately claim a $16,000 deduction. Depreciate the remaining $64,000. If you're in the 28% tax bracket, that's about $4,500 cash back this year. But here's the key. You still spent the $80,000. The deduction helps with cash. But here's the key. You still spent $80,000. The deduction helps with cash flow, but it isn't certainly free money. The real value comes when that irrigation system saves water, reduces labour and increases the yield of your property. That's where your return on investment really happens. Most farming equipment and infrastructure qualifies, but again, like everything, the devil's in the detail. What definitely qualifies are new tractors, harvesters, milking systems, irrigation equipment and water storage facilities. Farm workshops and also commercial buildings, livestock handling equipment, grain storage and processing equipment. The key point is it needs to be new or new to New Zealand. This means you can buy quality used equipment from overseas and still qualified, provided it hasn't been used in New Zealand before. What doesn't qualify is second-hand equipment already used in New Zealand, farmhouses or residential buildings, and of course anything under $1,000 which you already get a full deduction for. Repairs and maintenance or land purchase also don't qualify. One common question is vehicles. Utes and farm bikes can qualify if they are exclusively for business use, but personal use components do not qualify. Here's when farmers need to think strategically. Every dollar spent only saves you 28 cents in tax. Your 20-year-old milking system constantly breaks down, increases labour costs and affects milk quality. A $120,000 upgrade qualifies for $24,000 immediate deduction, but more importantly, it reduces maintenance and improves efficiency and potentially increases the production of your farm. The tax benefit is a bonus. The operational improvement justifies the investment. Option 2 could be you hear about this incentive and buy a $60,000 cultivator just for the tax break, even though your current equipment works fine. You get $12,000 in deductions, but you have $60,000 less in the bank for equipment that you just didn't need. The rule is simple. You make the purchase without... The rule is simple. Would you make this purchase even without the tax incentive? If not, don't do it. The claiming process just requires some attention to detail. First, keep meticulous records from the purchase to installation. The IRD may require proof of assets that work with a qualified accountant to properly record assets in your depreciation schedule and claim the deduction in your IR10. Think strategically about timing. If planning major purchases, consider timing them to best use of your cash and these tax benefits. Most importantly is to integrate any purchases with your long-term farm development plan. Use the incentive to accelerate investments that fit in your 5 and 10-year vision, not just random purchases. At CMK Accountants, we're helping farmers develop strategic investment plans that maximize tax benefits and operational improvements. The 20% investment boost offers real opportunities for forward-thinking farmers, but requires strategic planning and professional guidance. Only invest in what your farm genuinely needs. Keep detailed records, work with qualified professionals, and think long-term. If you're considering equipment or infrastructure upgrades, don't navigate this alone. Contact CMK to discuss your specific situation and then develop a strategy that maximizes both tax benefits and farm productivity. What investments are you considering for your farm? Let us know in the comments, and if this video has helped, please share it with others. Don't forget to like or subscribe, and remember, at CMK we're here to help your farming business thrive. Until next time.